put and paying the premium of $600 in this particular case. And notice that was for the 35 put. Later, the investor liquidates the position. So what happens? How do we liquidate this position? Well, we open by buying, so the closing transaction would be a sale and would be entered over here, but they don't tell us what that closing premium is directly. All we know is that the investor closed out just before expiration. Those are the key words in the problem. Now, what information can that give us? When we close out just before expiration, what's the premium going to be? Remember that a premium consists of two parts, time value and intrinsic value. But just before expiration, there is no time left. The option is about to expire. So when you see this type of language, you assume that there is no time value because we're just prior to the expiration date. So the premium and the intrinsic value will be the same in this situation. So since the option is a put, then of course what we would do is to calculate the intrinsic value by figuring out whether it is in or out of the money. So in this situation, the stock price when the investor liquidates is $34.50. The strike price is $35. And we think again, put down. Yes, this put is in the money by half a point. So that's again half a point, 50 cents per share times 100 shares. The intrinsic value then is $50. So we're closing out at $50 in that situation. So the net result is a loss of $550. Now, closeouts occur fairly frequently. If we look at the three possibilities, the investor could exercise the option, it could expire, or we could close it out. Now, very few are actually exercised because it turns out that the transaction costs that are involved, the inconvenience of dealing with the stock and the ease of closing out make that a more attractive alternative to exercising an option. Now, so far, we have examined the use of options as basically speculative investments. For example, if you believe that a stock was going up in value, well, think about your diagram. With stocks going up, that means that I could buy a call or sell a put. On the other hand, if I thought that the stock might go down, I could buy a put or sell a call to speculate on whether that was going to occur or not. But options can be used for other things as well. For example, an option could be used as a defensive investment. So let's take a look at an example where the other use for an option might occur. Now, here we have an investor who believes that stock is selling at an attractive price right now, but is concerned that the market might fall once the stock is purchased. So if the investor buys the stock, what option positions would provide downside protection? So notice that the investor's motivation for looking at options in this case is as protection. Now, this is a little bit different motivation than we've seen before. So the use of options as protection is called hedging. In this case, we're trying to protect the long stock investment, that is, stock that we already own. Now, this would be a long hedge, protecting a long stock. Now, our main investment is the stock that we own. If the market value of the stock rises, then we should have a profit on our stock position. But what if the stock falls? Well, if the stock falls, then we could have a substantial loss. Remember that in our example, we had $8,100 tied up in our stock? In order to limit the possible loss, we also have a secondary investment, our hedge. And what happens is that this must be an investment that will produce a profit in case the main investment begins to lose money. So what we're hoping is that the profit on our secondary investment will offset at least some of the loss that we have on our main investment, hence the idea of hedging. Now, if an investor is trying to protect a long stock position, we need to figure out what kinds of positions will provide protection to our hedge. For that, our basic option diagram can help us. Let's think about how we can use it. We're concerned that if we buy stock, the stock that we own might fall in value. We would like to have an option position as a hedge that will be profitable if our stock falls in value. Well, in fact, that's what the arrows on our basic diagram tell us. What option positions would be profitable if the stock falls? Well, notice, according to our arrows, that it would be the long put and the short call that we would be looking for. Now, it turns out that although both of these could be useful as a hedge, one is better than the other. The long put will provide better protection than the short call because remember that you own the long put. You decide when to exercise the option, if ever. With a short call, you simply have an obligation to do something. And although you receive the premium, you don't control the exercise of the option. So we're going to look at an example where we're going to use a long put option to protect a long stock position. In our situation, the investor has long 100 shares of XYZ at 81. Now, when we say long stock, What we're saying is that this investor owns the stock. So they have invested $8,100 in this position at this point. As a hedge, we're going to buy an XYZ January 80 put for $600. Now, to see what's happening with this position, it can be helpful to set up a T-chart because that explains everything that's going on. Now, we're starting by entering the $8,100 that the investor has spent on the stock, and we indicate, of course, that that's associated with the stock position. We also enter on the paid side the premium of $600. Now, remember that we did have to pay for the put, and therefore the premium is the cost for the 80 put. Now, how does that put act as a hedge in this situation? Well, let's look at the example. Suppose that this stock, which we originally bought at 81, suppose that it fell to, say, $45 per share. Now, if you didn't have this hedge, obviously you're looking at a very large potential loss in your position. But in this case, remember we have an 80 put. What is that? Well, that's the right to sell the stock at $80 per share. That's the strike price. So no matter what the stock is actually worth in the open market, this means that the investor will never receive less than $8,000, the strike price for the stock, as long as we have that put option for protection. So the worst that could happen to this investor would be that they would have paid out $8,700, $8,100 for the stock, and $600 for the option, and receive $8,000 overall. So they would have a loss, but that's the maximum possible loss of $700. So the put option, we can see, acts as a safety net. If the stock starts to fall, we don't have to worry about it too much. We might have some loss, but we won't have an enormous loss because we can always take that stock and force someone else to buy it at the strike price. That strike price gives us a level of comfort. That's the protection we get. In fact, we can think of it as an insurance policy. If you have a major disaster on your stock position, the put option is the insurance policy that is there to protect you against having too large of a loss. Now, here again is what our position looks like when we have set up our hedge. We want to look at some other things about this position, though. Now, we have to hope to make money, of course, as the stock goes up, but how high must the stock rise before we have a profit? We looked at what happened when the stock went down. Well, since we've paid out a total of $8,700 so far for these two parts of the position, we must receive at least $8,700 just to break even. Above $8,700, we'll make a profit because we will have gained more on the stock position than we originally had invested for the total. So there is no ceiling on the possible amount of profit that we can make on this position. $8,700 is significant because that turns out to be the break-even point. If the stock is at 87, it's worth at least the total amount of money that you paid for both positions. So in general, to find the break-even point on a hedge position, we think, how do we make the amount paid equal to the amount received? And so by